Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today, we're diving into a report from the Federal Home Loan Bank of New York. Get ready for some financial jargon, but don't worry, we'll make sense of it together, or at least try to. It's like trying to understand your bank statement after a wild weekend, confusing but necessary. This is an 8K filing, which is basically a corporate oops, we need to tell you something form. It's used to announce major events that could be important to investors. The main point of this filing is about the bank creating financial obligations, debts basically. The Federal Home Loan Bank of New York, like other federal home loan banks, gets most of its money by selling debt, specifically consolidated obligations. Think of these as IOUs or bonds that they sell to investors. It's how they raise funds to operate. These aren't your everyday bonds though, they're special because all 11 federal home loan banks are responsible for them. It's like a group project where everyone is on the hook. These banks are overseen by the Federal Housing Finance Agency, which can make any of the banks pay up if another one can't. This is important because it highlights the safety net built into the system. These consolidated obligations are not backed by the United States government, they're only backed by the financial health of the 11 federal home loan banks. Now, Schedule A, which is attached to this filing, lists all the bonds and short-term debt notes that the federal home loan banks are committed to issue. This schedule gives a snapshot of the bank's borrowing activity, showing how much debt they're taking on. But here's the catch. This schedule doesn't give the full picture. It doesn't include debt that matures in a year or less, and it doesn't show whether the money raised from these new debts will be used to pay off old debts. So it's like looking at only part of your credit card statement. Also, the amounts listed are the face value of the debt, which might not be what the bank actually receives after discounts or premiums. Think of it like a coupon you use when buying something. The face value is different from what you actually pay. Unfortunately, there is no Schedule A in the filing we have here, so we can't really look at any numbers. The report is signed by Eugene Kaysen, Director of Funding and Liquidity Management Treasurer. Now, let's step back and look at what this all means. The federal home loan banks play a critical role in the US housing market. They provide funding to local banks, credit unions, and other financial institutions, which in turn lend money to people to buy homes. So when these banks issue debt, it ultimately affects the availability and cost of mortgages. The fact that the consolidated obligations are jointly and severally guaranteed by all 11 banks is a key strength. It reduces the risk for investors and allows the banks to borrow money at lower interest rates. However, it also means that if one bank gets into trouble, the others could be on the hook, and that's a risk to keep in mind. Without the details of Schedule A, it's hard to make a precise judgment about the bank's financial health, but the very act of issuing debt isn't necessarily bad. It's a normal part of how these banks operate. The key is whether they're managing their debt responsibly. In conclusion, this 8K filing is a window into the Federal Home Loan Bank of New York's borrowing activities. While it doesn't give us all the details, it highlights the importance of these banks in the housing market and the shared responsibility for the debt they issue. Thanks for watching. If you found this decoder helpful, please subscribe, like, and comment.